Welcome back to the next segment of our morning's agenda, where we will be moving from global emerging markets to global equity. And we have Mike Moore, Portfolio Manager at Veritas Asset Management. Mike, thanks as always for joining us.
Thanks very much.
Now, Michael, I often get asked by clients, how do I gain exposure to AI? And I say, well, if you invested in a passive emerging market or a global world index, you have no doubt have significant exposure already to AI. And you do have, in your content today, you speak a little bit about concentration and how that's developed in the market. But I think before we move on there, the numbers. Let's talk about the numbers. So how's the fund done in the recent quarter and in recent history for that matter?
Sure. So in the last 3 months, the fund has delivered 8.7% return versus the MSCI World Index at 13.8%. Obviously, that's lagged what is a sort of very fast rising market. And we are lagging on the kind of 1, 3, 5 and since inception versus the wider sort of global equities index. But the returns have been sort of abnormally high versus sort of long periods of history. What I would say is since inception, we are delivering on our CPI plus 6% target of 8.6%. That though is below where we are in terms of the kind of the MSCI World. We are absolute returns focused, but we are disappointed we're not we're underwater versus the wider index. There's really been 3 reasons for that, and I go through each one briefly. The first is that the sort of durable quality as a sort of style has been sort of under pressure for sort of the last 3 or 4 years, and that's been a headwind. We've also had exposure to healthcare, which during sort of the post-COVID period, that has seen sort of greater pressure at sort of a sector level. And then in terms of the stock selection, we did have some areas where I think we could have improved, and we have actually rectified those, and we're actually seeing some green shoots there. And then finally, to the aspect you talked to, which is AI, the AI semiconductor value chain, which we've had relatively low exposure. We have had exposure to AI, but that's been very much in the kind of more durable sort of service provider space. So we haven't had as much in sort of the picks and shovels, and that's obviously been sort of a headwind. I think going forward, what gives us a lot of confidence is we do think we are at or nearing a nadir in terms of sort of the quality factor being sort of derated versus the wider market. And one thing that I think is really important to note is that actually the underlying operations and fundamentals of the businesses that we own are actually very robust and are in line or ahead of our expectations. I think coupled with this, we are seeing areas in the market which are seeing high concentration, some elements of sort of frothiness. And again, we're not sort of anywhere near as exposed to those sort of areas as the wider index. So we feel we are in a very good position to deliver absolute risk-adjusted returns that are very strong over the forthcoming period. I think if we move to sort of the attribution, it really mirrors what I've said there. And so the 2 key detractors on the 12-month and the 3 months are really the information technology sector and financials. And in financials, a lot of our exposure are into intangible assets, data assets. And in the information technology space, we are sort of exposed to software companies. Now, that's actually been an area that is contrarian at the moment. We've actually been stepping more into that because we think a lot of the kind of the negative sort of commentary around some of these spaces is misunderstood. And we do think you are seeing a real opportunity to get access to companies that have not been as cheap in a decade for the level of quality that that those companies possess. And I think that's been kind of the key sort of driver of the underperformance over the last year. One other aspect just to talk about is healthcare that I noted sort of just previously. There, we've actually seen the kind of the headwind there abate and actually turn into a positive over the last 3 months as we've gone through that and taken a root and branch approach from the bottom up and sort of pared down our exposure, but added to the positions that we have most conviction in. And so that is actually sort of some green shoots that are coming through there. But overall, we see the portfolio being well positioned from a sort of financial characteristics aspect and actually an earnings delivery sort of profile with a low valuation, which is actually relatively rare.
Thanks, Mike. I think before we dig into some of the major holdings and positions in the fund by sector and geography as well, since we last chatted 3 months ago, you've made a few noticeable I guess, sells and buys and additions to the portfolio? Maybe just summarize those for us.
Yeah, absolutely. So I think in terms of the activity on the fund, what I would say is it's kind of an increase in the quality, because we have seen a lot of volatility, and that's allowed us to actually sort of rotate the portfolio into, say, higher quality investments. One such is a new purchase in S&P Global. So that is a ratings agency. It's 40% of the business. Very high barriers to entry, oligopolistic. It's required by their customers and has strong pricing power. It has another 20% in its index business, and then the remainder in data assets. And there is a portion of that, sub 20%, that is workflow solutions that people perceive as being threatened by AI. We've gone into that in a lot of detail, and we think that is a overstated sort of threat. And the company was being offered at sort of low 20s Ps, which it hasn't really traded at in a long period of time, for durable sort of mid-teens earnings growth over our sort of forecast period. So we thought that was a very attractive opportunity. At the same time, we sold out of Salesforce, and the reason for that is we felt that Salesforce was our most most in the vicinity of AI headwinds. We still think it will be fine, but the issue there was that actually it was sort of starting to not track against our thesis. At the same time, and that was in terms of growth, and at the same time, there was excessive management turnover, which is an amber flag on our risk checklist. So given that both had been sort of driven down by kind of the thematic sort of AI headwind, we felt that it was the right opportunity from a risk reward perspective to actually upgrade the quality into S&P. In terms of Stryker, that's a sort of medical equipment, medical devices company that makes sort of things like knee and hip replacements, that sort of thing. There was an issue around sort of cybersecurity and a miss of execution that created a temporary disruption to the business. But the end market has strong oligopolistic tendencies, structural growth, and a very, very strong management team. And so again, we took that as an opportunity to actually deploy capital into a high quality asset. At the same time, we had a relatively small position in Zoetis, which is animal health. And there we had concerns around management execution within their key markets. And what actually happened in a recent set of results was that the management actually sort of slightly changed the way they were reporting organic growth. And that, again, is a red flag from our risk checklist. So we actually, instead of increasing the position, we decided to actually exit that in totality. I'll talk to sort of Vulcan Materials sort of later. But in terms of the other complete sale, one that I would note, because we've held it for a long period of time, is Charter Communications. That's a US cable broadband operator. It's in a relatively mature market. And what had happened over the last 3 or 4 years is a 5G mobile broadband operator had come into the market and sort of pressurized share. Now, that was abating because basically they were coming up against capacity limits, which is a uniquely sort of mobile problem versus cable problem. But at the same time, there are actually sort of technological features that can manage to push that capacity limit to the right. And so we were seeing that at the same time that products like satellite broadband with Starlink were coming into rural segments, and again, sort of clipping the opportunity for growth. So with that backdrop, the company was also relatively indebted, at 4 times net debt EBITDA. And so the range of outcomes had widened for that security. And so we decided, again, up or out, we decided to actually exit the position. In terms of the sort of wider portfolio positioning, I think there are a few things to call out. I mean, we obviously look at things from a bottom-up perspective, but I would say travel and aerospace is a key theme within the fund, and 3 of the top 5 holdings, Vinci, Airbus, and Safran, are in that theme. And secondly, the biggest sort of increase in sort of weight, I would say, is financials, and that's because we're finding opportunity. And so there you've got kind of MasterCard, LSE, Aon, all in the top 10 now. And when we think about the sort of broader sort of positioning of the portfolio, we've actually got a relatively diverse sort of list of sectors that all have a sort of similar amount of exposure. So industrials, financials, healthcare, and information technology, when you include companies like Amazon and Amadeus from consumer discretionary, are all around that 20% sort of mark. That's not sort of an intentional thing we've driven. That is just because there is a diversity of sort of ideas coming from different areas where we see value. And I would also say with that, you're obviously seeing relatively full aggregate valuations for the market, but we are finding a number of idiosyncratic opportunities, and so that's why the cash is relatively low, despite sort of more sort of extended aggregate valuations at 1.7%. But in terms of the sort of region split, that's not something we tend to think about, but we do it from a sort of bottom-up perspective.
Thanks, Mike. I mean, just looking at that sectoral breakdown, it's quite a diverse set there. Your next few slides speak to market concentration, which is what we opened with, and bifurcation, which is a word I don't typically use. I told my partner the other day when she's driving down the road, she must take a right at the bifurcation in the road. So yeah, it's basically a dislocation or a divergence there. So we are seeing the biggest disconnects between price and quality, because there's quite a lot to absorb in this.
Sure, absolutely. So I think one of the things that I would note is just that market concentrations are at levels that we've seen at sort of prior market peaks. And so the left-hand chart on the slide shows the bubble history of stock market concentrations measured as a percentage of US market cap. And so on the left-hand side, you've got in the dark, I think it's dark blue, railroads in the kind of the 1800s. Then you've got the Nifty 50 in the early 70s. The TMT is kind of the darker sort of grey blue around the end of the century, and then now the kind of the AI Big 10 being sort of 40%, sort of that sort of level again that we're seeing. And so all we would say is that actually that concentration typically is not a great precedent historically, and so it's something to be vigilant about. I also think this is also a factor in terms of the S&P 500 IT weighting is now above the dot-com peak at 36%. And really, when we're sort of looking at this and sort of thinking about this, when you look at the aggregate valuations and you look at things like a cyclically adjusted PE or a Schiller PE, those are relatively full or extended versus history. And so, at the moment, it's not that everything is expensive. What we're seeing is there are pockets that look expensive, or that looks like the earnings power, the sustainability is questionable. But there are also a number of other opportunities in sort of more unloved sectors. And I think one of the things that's exacerbating that is as fund flows go into these equities, they're actually sort of depressing the other areas as well. But that is presenting a significant opportunity in our view. The second point I would make is even with this kind of the AI concentration, the kind of the fragility of that, I think, is increasing in terms of whether people are just using sort of tokens or increasingly using AI and not thinking about the ROI. This stuff is expensive. There are also things like memory that's pushing prices up. You're getting things like reports of sort of double ordering, that sort of thing, and long-term agreements. Again, this is sort of kind of characteristic of sort of frothiness. And then you have quite a lot of kind of euphoria about sort of new market sort of IPOs and things as well, that actually have relatively, I'd say, poor financial criteria. If you're looking at sort of things like free cash flow, margins, that sort of thing. And so all of this is sort of increasing the fragility and sort of raises questions. But we do think there is a significant opportunity in the kind of the quality, sort of durable quality side of the equation. And so the next chart shows that bifurcation. So where you've seen a very sort of hot part of the market, but we think there's an awful lot of value that's coming through in intangible assets, in software, in data assets especially. And so what you see here is kind of the valuations of the S&P Global, SAP, Amadeus, and London Stock Exchange, which are 4 of our holdings. And you can see what's happened is they've kind of derated in unison over the last sort of 3 years, especially over the last year. And what we're really seeing is a kind of a step down in unison, but then these have different risk profiles to AI, and it's really our job to find out the ones where that's being mispriced. And so we do think that the number of these moats are being underappreciated. And so, SAP is a classic example where it is entrenched in logistics operations, finance operations across numbers of enterprises worldwide, very, very entrenched. And you just have to look at what the kind of Gartner contract expert said about the company. Customers have no choice. They cannot switch vendor. They have to migrate to SAP's newest products, which does kind of AI enable them to be perfectly honest. And they will need to buy additional modules and will spend meaningfully more on SAP. And so this narrative that software is kind of dead is just far from the mark. And in fact, in many ways, the data centricity of things is getting more important. And so actually provides potentially a tailwind for these businesses through time. And so we think that is an extremely compelling and attractive opportunity sort of going forward. I think one thing just to sort of take a step back from is to think about this at the aggregate level as well. And when we're looking at our portfolio, I think one thing to really focus on is just how we compare and what are the statistics across our group of companies. And if we look at the kind of the return metrics, what we call the CFROI, which is the cash flow return on investment, that is around 22% for the fund. That's around 5 points higher than the index average. It is also we also have operating margins of around sort of 23%, which again is about 9 points higher than the than the index as well. And then in terms of those quality criteria, those are just two. Typically, you've had to pay a premium for those, but now you're actually getting those at a discount. So the free cash flow yield over the last 12 months has been 4.4% for the aggregate portfolio versus 3.1 for the MSCI index. And so in an absolute sense, we think these are very compelling metrics that you're presently being offered. Sort of you're seeing decade lows in a number of these valuations. And this compares very favorably on an absolute basis and also versus the wider market. And that gives us a lot of confidence going forward. I'd also say that the companies that we have are actually delivering on their kind of revenue growth and earnings growth that are sort of touching sort of double digits over kind of over the recent past and more. And so we do feel sort of very confident in being able to deliver strong absolute risk-adjusted returns.
Thanks, Mike. I mean, your next slide speaks to the portfolio adjustments by theme, and it's interesting. It appears to me that you're not making a binary bet for or against AI, but instead looking to, I guess, upgrade the quality of the portfolio by allocating capital within those different opportunity sets. Is that a fair observation?
Yes, it is. I think we've really sort of doubled down on focusing on sort of an up and out. So given the volatility that you're seeing in sort of share price and valuations, it's really making sure that we are on track with our investment theses, and when they're going off track, is to sort of nip them in the bud very, very early on. And so if you look at what we've done, where we've actually had a dislocation and an ability to increase the position or upgrade the quality, we've done that. So you can see that in healthcare with Stryker and Thermo Fisher, which are extremely well managed businesses and leaders in their industry. Whereas we exited Bio-Rad and Zoetis because of the management execution. In data and software, we've increased the aggregate weighting, but also up the quality with LSE Group, SAP, and S&P. And we've done that, and we've actually taken out Salesforce, actually because it wasn't sort of tracking to our thesis as well as we thought it should, and we felt that this was an upgrade to quality. Global mobility, obviously the unfortunate sort of conflict that's going on in the Middle East has sort of provided a sort of downwind for all of those sort of affected companies, and we've again used those to sort of increase positions whereas we see this is sort of relatively temporary. So Airbus, Compass, Hyatt, MasterCard, and then finally in infrastructure we've added a new position in Vulcan Materials, which gives us something different and very strong pricing power. Whereas we've actually sort of exited that charter position because, again, it was actually sort of veering off thesis. And so we've actually been very diligent about sort of increasing our strongest conviction ideas.
Thanks, Mike. Yeah, because it's quite easy to lose a little bit of focus and get caught up in some of the AI and the mega cap themes that we are seeing. And you mentioned earlier in the presentation your addition of Vulcan Materials to the portfolio. I mean, in today's world of such geopolitical uncertainty, tariffs, inflation, surprises, etc. I mean, how important is something like pricing power when you're assessing long-term investments? And I guess Vulcan falls within this remit.
I think if you were to sort of rank what are the most important factors, pricing power would be right up there. And so Vulcan Materials has very strong pricing power. So it has sort of pricing is compounded, industry pricing is compounded at 4% for 45 years, including the GFC. And that gives you some idea of the real pricing power that this business has. The irony of Vulcan Materials Company is it's actually, the product is very simple. So it is aggregates, it's things like sand, stone. They typically sell for sort of $25, $75 a ton. But the real value and the real reason they have strong pricing power is that these are local monopolies that have been consolidating over the last couple of decades. And the cost to move this stuff, because it's very heavy, is actually sort of exorbitant and actually diminishes the radius that you can go. So if you have existing quarries or sites, and especially sites near cities where there's demand for construction, that sort of thing, that's actually a real benefit. And given sort of new permitting, environmental factors, it's quite difficult to build those new sites. So these are kind of really a lot of local monopolies. It's consolidated. There is strong pricing power that's actually, if anything, getting stronger. And I think in terms of the kind of the underlying growth drivers, obviously infrastructure volumes, it grows at a relatively sort of modest sort of volume growth. But it's really that pricing kicker that is important, and they are sort of delivering on that. Now, the second point that I would say is that actually, 2/3 of the market is actually is owned by private companies, and so it actually also acts as an opportunity for them to acquire smaller assets and fill in assets to increase their strength in these local monopolies over time. So there's a long runway for that as well to supplement the growth. And so when you're getting these price rises coming through, that is coming in at quite high incremental margins and sort of increasing gross profit per ton, because the cost of getting the stuff out the ground isn't as significant. And so that really drives considerable free cash flow per ton growth and free cash flow per share growth for the businesses that they can redeploy. And I think in terms of that real pricing power, given the geopolitical uncertainty, given a potentially stickier, higher inflation environment, we think this is a rare asset that the company possesses. And I would say that it isn't in that kind of AI complex or anything. It is something that is quite idiosyncratic, and it's different to other things in our portfolio in terms of its exposure. The final thing I would say on this one as well is that it is very much in our wheelhouse of the types of company that we look to invest in. Very strong market positions, diligent capital allocation, strong pricing power. And so we do think that actually it will be a valuable addition to the wider portfolio through time.
Thanks, Mike. Yeah, I think a key takeaway from today is this bifurcation. I'm going to get it one day when it's part of my daily language. Bifurcation in the market's really driven material quality derating, and it's understanding that idiosyncratic change in the markets. And yes, being cognizant of AI and having exposure there, but also looking beyond that at other industries and where that opportunity set lies. And I think you painted that picture quite wonderfully for us, even though I seem to slip my tongue through this process. But yeah, thanks for your time today. We look forward to chatting again in 3 months and seeing how the next quarter does go. And all the best to you and the team. Take care.
Great, thank you.